Ladies and gentlemen, good day and welcome to Chennai Petroleum Corporation Limited Q4 FY24 conference call hosted by Elara Securities Private Limited. As a reminder, all participant line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gagan Dixit from Elara Securities. Thank you and over to you, sir.
Yes, thank you. A very warm welcome to everyone to discuss Chennai Petroleum Q4 FY24 result. It is our pleasure to be able to bring to you the management of Chennai Petroleum Corporation Limited, which is led by Shri Rohit Kumar Agrawal, Director of Finance, Shri Venkateshwaran, Chief General Manager Finance, Shri Anil Sani, Chief General Manager Technical Services, Shri P. Shrikant, CGM Technical, and Mr. P. Satishan, Chief Manager Finance. We would also like to this opportunity to congratulate the management on its excellent set of numbers. So with these words, I will now hand over the conference to the Chennai Petroleum management. Over to you, sir.
Thank you, Gagan. I hope I am loud and clear, audible?
Yes, sir.
Yes.
Okay. Good afternoon, everyone. I am Rohit Agrawal, Director of Finance, Chennai Petroleum. Thank you for joining this call today. On behalf of the CPCL team, I welcome you all to this post-quarter 4 result Concall. Before we begin, let me start the disclaimer that some of the statements we would be making during this Concall are based on our assessment of the matter and we believe that these statements are reasonable. However, the actual results could be different depending on uncertainties and actual events. Our results of quarter 4, 2023-24 are with you for now for quite some time. I will not go into the same. However, if you have any queries on this, we'll surely take them up during our Q&A session on this Concall. It is worthwhile to mention that financial year 2022-23, the physical performance of CPCL was the best ever. And CPCL was bestowed by MOPNG, CHT, the Best Refinery Performance Improvement 2023 award in the large refining capacities, more than 9 million, which constitutes almost all PSU and private refineries. And the year 23-24 is even a better year than the previous year, that is 22-23. So you would understand the point is that this improvement is happening over a large base, a significant improvement which has happened last year. So let me bring some highlights of performance during 23-24. CPCL achieved highest ever crude throughput of 11.64 million metric ton, which is 111% of installed capacity, 10.5 million, as against previous best of 11.32 as we discussed in the just previous year, that is 22-23. And this is attributed to efficient operation coupled with enhanced reliability. Just to mention, we have crossed 1,000 TMT crude throughput in 8 of the 12 months. So consistently this performance has been achieved. This reflects our agility to scale to new heights during the period of healthy margins by encashing the available opportunities. The next big achievement we have achieved is the lowest ever. Thank you. Sorry for the interruption. We were just starting with highest ever throughput. Then we talked about fuel loss and other energy parameters which are very significantly improved. And the next point was the highest ever annual production and dispatch of petroleum products like MS and HSD and niche products like LOBS, hexane, MTO. Even in the RLNG space, CPCL processed highest ever RLNG of 441 TMT during 23-24 and the previous best was only 270. Again, this is considering economics and environmental sustainability. During the financial year, CPCL processed 61.5% high sulfur crude and we kept our crude sourcing basket to be flexible and about 50% were long-term agreements and we took advantage of the spot depending on the price and the crude grade to capitalize on price economics. CPCL is committed to developing a new scheme on energy efficiency, fuel and loss reduction, and also develop enhanced production of value-added products. So our fuel and loss and energy parameter, whatever significant achievement we have done, we have a roadmap to further improve it and further harness value for the stakeholders. On the financial performance part, the gross refining margin GRM for FI full year 23-24 was $8.64 per barrel. If you benchmark it against Singapore GRM, which was $6.61 per barrel, the previous year, we achieved 11.91 USD per barrel against the Singapore GRM benchmark of 8.96 per barrel. The point to highlight is we have been, beating the benchmarks by our efforts. Second is quarter. The GRM for quarter 4, 23-24 was $7.71 per barrel against the Singapore benchmark of 7.32. The previous year's same quarter, Q4, we clocked 12.48 against the Singapore benchmark of 8.10. We all know that in the international market, the cracks have lowered, but still our efficiency and our efforts were continuing to beat them. Our current GRMs have been at a premium to Singapore GRM as explained over the past 2 years, mainly on account of continuous optimization of refinery production, product distribution, crude procurement, and efficient handling of processing capabilities. On the financial position, our leverage position has considerably reduced. As on 31 March 2024, it is 0.32, as compared to 0.67 previous year end. Borrowing stands at 2762 crore as against 4235 crores in the previous year end. Our closing net worth in the present year end 31st March 24 is at 8,593 crores as compared to previous year 6,281 crores. As we have embarked on this consistent and robust profitable journey, our disciplined and healthy dividend payment framework continues. Our board recommended highest ever dividend of 55 rupees per equity share, that is 550%, on a face value of rupees 10, for the current year, that is 23-24, certainly which is subject to approval of shareholders in the AGM. And this is against a net profit of 2711 crore posted in the current year. On the capex front, one of the important projects that was being undertaken by CPCL in a JV with its parent IOCL was Cauvery Basin Refinery Petrochemicals Limited. Again, the revised costs have been approved by both the boards in February and March, and the revised capital structure has also been approved. And we are awaiting CC approval. We are proceeding with the ministry, and we now feel this project will go on a faster pace towards implementation. On the governance side, it may be noted that last year CPCL reported its first integrated report in the journey of disclosing our ESG profile. CPCL has continuously focused on mitigating its environmental and social risks. Some of our key initiatives include investment in BS6 compliant fuel earlier, high usage of RLNG, and installing renewable energy plants. Our governance structure is characterized by agility in its board composition to take timely decisions, healthy investor grievance redressal, and extensive disclosure. CPCL understands the importance of ESG among investors and lenders and is focused on enhancing its disclosure practices and will be closely monitoring the best practices in this field. We reiterate that CPCL is committed to the ESG principles that enhance the stakeholders' confidence given its overall debt and access to both domestic and foreign capital markets. The continued global uncertainties are anticipated to continue, and which may result in volatility of crude oil and product prices in the coming time. While these are broader factors that drive volatility, we remain focused, on our operating our refinery in an efficient, safe, reliable, environmentally responsible manner, and continue to focus on key metrics that control operating costs, as well as profits. By taking care of short-term as well as long-term goals of our shareholders. To wrap up, I can say that we continue to deliver resilient operational and financial performance and see the momentum to continue in the new financial as well. Thank you once again. Now we are open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Tejas Shah from Laser Securities. Please go ahead.
Hi. Can you just throw the light, what is the stocks profits this time being the oil price differential? And right now, what is the carry cost of the oil quarter ended this March?
Inventory gain. I suppose you asked inventory gain.
Yeah.
Yeah. So, in the full year 23-24, the inventory gains are 43 cents, $0.43 per barrel. And if you want in rupee terms, it's 300 crores affecting the profits.
300 crores affecting the profits. Okay. What will be the current debt on the books?
It's 2,700 crores. Down from 4,200 crores in previous year.
Okay. Any plans of repaying? Means we are doling out healthy dividend, but then why we are not using it to just repay the debt?
As you would notice, already 4,200 has become 2,700. You would also appreciate some of these are long-term loans, which are at very reasonable cost. And certainly would like to employ them and take advantage for the shareholders.
Okay. Thank you.
Thank you. Next question is from the line of Sangeeta Purushottam from Cognito Advisors LLC.
Yeah, this is a partner, Andre Purushottam speaking. I have two questions. The first question is that in your other expenses, you have a significant cost, I think, coming from forex gains or losses, right? Mm-hmm. And this creates a fair amount of volatility in your earnings that you report. So I want to know as to what is your hedging policy, and do you see this factor smoothing out in the future, or it will continue to have an up and down feel to it?
What I have understood, you want to understand the forex impact on our profit. So last year this was significant, little over 500 crore FE impact loss on our P&L. This time it is not significant because the rupee remains stable. It's hardly 70 odd crores. So right. That way, these profits are not impacted by forex. But as you know, crude remains a large part of it. So forex needs to be taken care. So we take with the help of our parent, we take active measures so that this is kept to the minimum. And then, as you would know it, the way RTP has been designed, in large extent, large natural hedge exists between this FE. So we articulate all. So we take into consideration the natural hedge, and then wherever there is an opportunity to lower the impact, we do that.
So is it reasonable to assume that this sharp volatility in foreign exchange gains and losses will reduce in the near future?
Again, I think the guess, my guess would not be very different than your guess. But I feel after the last year sharp volatility in rupee dollar, it's more or less stable now. Where it is very moderate or very, the fluctuations are very less. So that would be my guess, but I hope it will be your guess also, because no one can predict it very precisely.
Right. And as refining margins are, the outlook for the next 6 months to 12 months, you expect them to be stable at the levels that they are. What are the factors which determine this margin? And if you could explain to us what your thinking on those factors are, we could get an assessment of the refining margins themselves.
Yeah, I think a pertinent question. Again, the way we deliberated about Forex, even the commodity prices are more volatile than Forex. And again, it is contributed by a lot of factors, geopolitical, demand, supply, unplanned shutdowns at other places, so many factors. And even we see the last 1 year that has gone by, there were periods when MS cracks were 2 or close to 0, it revived to 10, 12. Similarly, the HSD cracks and ATF cracks swing, very widely. But what we have seen in the last 1 year at least, last 1 year, is that overall it had remained reasonable compared to the long-term history. If you compare the 10-year history, they have remained reasonable. So again, I'll not like to guess something for the future. As a operating company, efficient company, our attempt is, in the given context, how do we, do our act together so that we take the best out of the given environment.
Thank you, sir, and congratulations for a great set of numbers, sir.
Thank you. Next question is from the line of Sunil from KOPL. Please go ahead.
Hello, can you hear me?
Yeah.
Yeah. So my question was a couple of things. One was since the distillate crack spreads are great, which are the product crack spreads which are resulting in the EBITDA margin falling?
Again, as we recall, this windfall tax last year was brought from 1 July. So first quarter, the cracks were, in excess of 30. So last year, if you see, 9 months was under an environment which was there 12 months this year. So because these annual numbers are average numbers, including the first quarter of last year, that is how the last year cracks looks to be higher. Otherwise, if you compare 9 months, last 3 quarters of previous year and then this year, then you will not find much of a difference.
Okay, thanks. The other question was regarding the cost of RLNG. Last year, why was it so high? It was procured from IOC?
It is not about securing. See, your refinery has to be ready to process RLNG. So CPCL was working on its plants and, it was making itself enabled so that we can process RLNG. The second factor is price. So first we enabled ourselves so that we are able to process RLNG in all our critical areas. Second, the price. And we took advantage of the right blend of short-term and long-term prices in the last year, especially the last 2 quarters. And we process more RLNG. So it is first readiness and second market condition.
Okay. All right. And also, what was the shortfall in revenue due to the windfall taxes over the financial year?
Actually, if you see, there is no shortfall in revenue. The whole shortfall is due to prices. If you remember last year at the beginning, the prices were 100 plus, the crude prices. So averages were much higher. Quantity-wise, volume-wise, there is positive. On an annual basis, if I am not wrong, the volumes are 5% up.
Okay.
So it's quantity variation positive. It's only due to price variation, negative.
Okay. Thank you very much.
Thank you. Next question is from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead.
Thank you, sir, for giving this opportunity. You had indicated earlier about the FY24 inventory gain at 0.43 per barrel. Would you be able to also share with us what was it during the Q4 and Q3?
Q4 current year, that is 23-24, was a loss of 0.59 and that translates to 112 crores. 0.35. Okay.
And is it also possible to share for Q3 as well?
0.35 gain. Q3 was 0.35 gain. And again, it will translate to some 80-90 crores of INR.
Right, sir. The second question was about the joint venture refinery that we are implementing with IOCL. Could you share with us the current physical progress, the milestone that has been achieved and milestone which are targeted for the next year?
Yeah, sure. So, if I combine everything and give you a single number, then you can put the physical progress to be around 9.8%. And if I go into details, land has been acquired 100%. All 4 EPCMs were awarded. As I said, revised cost and revised capital structure approval of both the boards obtained, and it is at the final stage of ministry approval. Most of the LSTK jobs and other jobs have been kept ready, so that it can be awarded on fast track. And the revised schedule we are looking at is 36 plus 3. 36 mechanical completion plus 3 months of commissioning from the date of CCA approval. So that way we have reduced the timelines for completion from earlier 45 months.
Right, sir. One more question if I can squeeze in. You mentioned about the RLNG increased usage. So could you also give us some more indication about what sort of the longer term contract that we have tied up and what is the maximum that we can use within the system? And in terms of the dollar per barrel terms, how much additional refining benefit it can translate to? Some indication in terms of the differentials?
Yeah. So actually, we had a long-term contract of 1.08. The unit was MMSC? Yeah, MMSC, which now we have revised upwards to 1.3. But I must tell you, even though my new long-term arrangement is 1.3, I have been using, intermittently as high as, more than two. So, if the economics permits, then RLNG usage can further increase. As regards the, benefit per dollar or something, I'll not be able to give you a concrete number because every month, the delta between long-term and spot is widely fluctuating. But do trust, it is based on economics as well.
Right, sir. Thank you for this clarifications.
Thank you. Next question is from the line of Ajay Vora from Nuvama. Please go ahead.
Yeah, hi, sir. Just a couple of questions. Where do you see our overall debt levels over next 2-3 years? Meaning, post the expansion also kicking in. How do you see your debt levels, say, by end of next 2 years?
You might have seen CPCL's debt level at more than 7,000 crore. Last year 4,200 crore, now 2,700 crore. But see, the way we see it, long-term debt or debt is one of the parameters that we look at. We also look at what are the profitable schemes that are available where margins can be enhanced. Say I have 12-13% IRR based projects with me, then I would like to utilize them at a right opportune so that I keep a balance between debt equity, debt or debt equity as well as returns. So, and I must tell you that the team is actively evaluating multiple small, medium projects which are high yielding. So, immediately there is no requirement of debt, but yes, going forward we are also looking at significant capex to improve our profitability.
So what do you mean by, what kind of numbers should we work with in terms of when you say significant capex? Over next 3 years, what kind of capex are we envisaging?
So I'll tell you what is certain. At this point of time, the CBRPL capex is 3,000 crore, out of which 1,000 crore we have already committed, spent rather, not committed. So balance 2,000 crore will happen over a 2-3 year period. But beyond this, the other profitable projects that I told, those are under evaluation at various stages. Those projects, individually will run between 200 crore, 300 crore to 500-700 crore, and one of them being 1,700 crore. But all those will depend on the approval and then the opportunity and the certainty. So all these are now at various stages of approval.
So all these new projects put together, can we assume that it can be somewhere close to 2,500 crores incremental?
2,000 crore over 2-3 years period is only CBRPL additional capex.
In addition to
normal maintenance capex as such for me is 200 crore per year. What I am hinting at is there may be another, annually 300-400 crore or 500 crore, but that depends only on profitability. So if I get a profitable project, certainly will not hesitate to maintain our debt equity, maintain our debt level, retain the debt level, and then go for enhanced profitability.
So, sir, in terms of, whatever CapEx which is going on right now, versus the current capacity, what kind of volume growth do we expect from the CapEx when it kicks in, and when do we expect that to start?
CPCL, the installed capacity is 10.5 million metric tons. Last year we clocked 11.6. So, and there is no plan of adding a crude unit because there will be, other restrictions here. And the new 9 million refinery that is coming, that will add 9 million capacity, which we talked about CBRPL. It will take 39 months to complete. Besides that, whatever new projects I am talking about, those will be value-added projects. So it will be some secondary adjustment, some niche product, formulation, some sustainability issues with profitability. So per se the crude intake may not go because of these projects, other than the CBRPL, which will add 9 million, but that is in a JV. But yes, profits will go up.
But that JV also that will come into play only after 3 years.
CBRPL will come into play only after 3 years.
Yeah. So from now till over next 2-3 years, we are looking at a more or less similar volume of around 11 to 12 types, right?
Yes.
And there can be profitability improvement because of many other things that we are doing.
Yes.
So versus this year's GRM, what kind of improvement are we envisaging for FY25?
As I have told, the GRM depends on lot many factors, including the crack that is available in the market. Only we can target is, fuel and loss, energy parameters, which are purely operational. So I think it will not be prudent to give a number on GRM because that's mostly dependent on factors which are given in the market.
Understood. And how has the cracks been so far? Meaning, too early to say, but for the current month, how has that been versus the last quarter's average?
MS cracks has improved, which was, last year throughout the period was less than 10, significantly lower than 10, now it's 12. HSG cracks has fallen, But again, last year, if you say month by month, they were not consistent. MS was 2, so there is a large volatility. And as you said rightly, it is too early, or rather, it is very difficult to predict in a volatile environment what would be the crack or what is the GRM for the full year.
Okay. Great. Thank you very much and all the best, sir.
Thank you.
Thank you. Next question is from the line of Vibhu Ayon from UBS. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on a great set of numbers. So maybe continuing on the discussion around CapEx. So as you mentioned, sir, maybe 2,000 crore over the next 2-3 years goes towards the Kavli refinery project, and we are looking at other CapEx options. So first thing is, can you elaborate as to what kind of projects we are considering? And secondly, will we consider this project after maintaining our dividend payout of 30%, which we saw in FY24?
First on kind of capex. So one of the project is LOBS, grade 2, grade 3 LOBS project, which will help us move in the value chain from petroleum liquid fuels to lube-based, products. So that's one that we are looking into. Others are like debottlenecking, some addition in propylene capacity, and again, some niche products. Those are the item on radar. Second, on dividend, even if I am paying 30%, I am retaining 70%. And with requisite debt, I don't think there need to be a swap between dividend and profit. But as you would know, we are a PSU. We are covered by DIPAM guidelines. We take care of the financial requirement. So after taking care of both, policy, the interest of the shareholders, minority shareholders, and as well as the capital requirement for their overall future well-being, a right decision will be taken.
Understood. So broadly, sir, what should be the capex number we should think about for FY25 total capex?
I think the budget is around 600-650 crore.
Okay, but sir, like this can only go to the CBR project, the equity contribution, right?
Then rather otherwise, see, CDR our is 3,000 crore. We have already spent 1,000 crore. So immediately our outflow to CDR will not go. It will come from the parent. You know, it will go mostly to other projects.
Okay. Okay. Got it, sir. Got it. And secondly, sir, can you please share for this year what was our total distillate yield? It would be great if you can give us a breakup of the key products. And secondly, if we see some improvement going into FY25, and also the same thing for the fuel and loss percentage.
Yes. So I'll tell you, the full year distillate yield is 76.2.
Okay.
23-24 full year distillate yield is 76.2, and that is over 76 in the previous year.
Yeah. Yeah.
And our attempt would be to maintain and improve this, but that depends on a lot of factors, including plant shutdowns and other factors.
Yeah.
And one more factor, I think it will be interesting, and worthwhile to note, that this distillate yield is also dependent on type of crude mix. Suppose we get some advantage in crude mix price-wise, then even if we compromise a little bit on distillate yield, still the overall profit will be higher. So all will be taken into consideration. All economic consideration will be taken into consideration, and effectively that will be improvised.
Okay, sir. And on the fuel and loss side, what was the FNL for this year?
Fuel and loss?
Yeah.
Fuel and loss current year is 8.81.
Okay.
But if there are no M&I shutdown, we can maintain or improve it. But depending on the shutdown, that element has to be factored in.
Okay, sir. Understood. So one last question, if I may. Can you please share the quantity of crude from Russia that we processed over FY24? And do we foresee any kind of material changes to that quantity in FY25?
Again, broadly, we have maintained it around 30% because, there are term crudes, there are other opportunity crudes, so we have to make a balance between all this. And except for M&I shutdown, we do not see a major change unless the economics changes significantly. If we get more opportunity crude elsewhere, certainly our attempt would be to maximize profits and margins. So for us, any crude is an opportunity crude.
Sir, our understanding is that the discount on this Russian crude has gone down over the last 3-4 months. Is that understanding correct?
Yeah.
Okay, sir. Thank you so much, sir. All the best.
Thank you. Next question is from the line of Hardik from ICICI Securities. Please go ahead.
Yeah. Hi. Thanks for the opportunity. So the first question is regarding the inventory windfall tax. So what was the windfall tax in per barrel impact for the full year this year?
If I theoretically calculate the impact of windfall tax, it will be around 900 crore this year. And 900 crore will translate to about $1.5 per barrel.
Okay. And this windfall tax is applied on the entire volume which we produce, right?
No. See, windfall tax is notified by government every periodically, fortnightly. And it is actually calculated based on that volume and that fortnight's rate. And it is product-wise. So at times, MS is nil, ATF is nil. So it's product-wise, year-wise, specific.
Right. So I just want to say that, whatever, so it would be the 100%. So whenever there is a rate, if it's 2.5 rupees per liter, so it would be on our entire volume during that period, right?
This 900 crore has been, for calculating dollar per barrel, is on the entire volume.
Okay, cool. And on the new refinery project which we are talking about, can you just help us understand how much part of it would be towards the propylene? Just want to understand the in terms of how much additional GRM benefit we can get from the value addition.
If I heard correct, I think you wanted to know about the petrochemical intensity.
Right.
as of now.
Sorry?
6%. 6%. In CDRPL, the petrochemical intensity is 6%, and that's PP. 1 unit of polypropylene is coming, with which the petrochemical intensity would be 6%.
Okay. Thanks for the opportunity.
Thank you. Next question is from the line of Falguni Datta from Mansoora Financials. Please go ahead. Ms. Datta, your line has been unmuted.
Hello?
Yeah.
Yeah, sorry sir, my question has been already been answered. Thank you.
Thank you.
Thank you. Next question is from the line of Tejas Shah from Laser Securities. Please go ahead.
Hi. In continuation, can you share what will be the cost of the government imposition of that additional tax that we are talking about, or for this quarter only? And now again, they've raised it, I think, 2 times. So will that impact be much severe?
The way I know it, SAED right now is nil. I think you might be talking about crude. But crude will not impact us. In our case, only SAED on products will impact us. And for the quarter 4, that was not significant. Hardly 40 crore was the impact.
Okay. So even in this current quarter also, we are not getting impacted on that, correct?
It's nil. So, as of now, it is nil.
Okay. And can you give us the reasons why this time the GRM was less, or the spread between the Singapore GRM and our GRM was not that high? Because what you have said, there's a pretty good difference, like 8.10 to 12.48 and all. But this quarter, it is only 7.32 to 7.71. So why the spread between Singapore and our GRM was this time less?
So first thing I'll tell you, you'll be finding that consistently CPCL is beating Singapore GRM. Second, Singapore GRM is a theoretical GRM where the configuration is more petrol driven. So depending on the individual product's configuration, the delta will not be same. So it is used as a benchmark to see whether we are beating it or not.
Okay, fine. Thank you.
Thank you. Next question is from the line of Roshni from Argus Group. Please go ahead.
Yeah. So earlier I remember that the deadline for the Chennai refinery expansion was supposed to be 2025 December. Is there a new timeline for this project?
As I said, this project requires CCA approval. There were land to be acquired. So the earlier deadline was with respect to that. Now we are saying from the date of CCA approval, the next deadline is 39 months, 36 months technical completion, 3 months commissioning. If you remember, the original deadline was 45 months. So because land has been acquired, some of the pre-feasibility work has been done. That is how this project was in a position to reduce the deadline, from the start date.
Okay. So is the new deadline still 2025 or has it been shifted to like end of 2026?
You have to consider 3 years, 39 months from recent times.
Okay. So we can expect it by say end of 2026.
27 you can consider. 24.
Sorry?
We are in 24, so 39 months.
Okay, so by end of 2027 you can expect it, right?
Yeah.
Okay, and just one addition, the CPCL Manali refinery, has it been going under maintenance in April this month?
This month we are not in maintenance. Maybe during the mid of the year we had a scheduled M&I maintenance.
Okay, so around June is expected to go for maintenance.
Maybe August, July, August.
Okay.
But as you know, exact date depends on so many other small factors.
Okay, but any amount, the duration for how long it will be under maintenance?
Broadly, you can say a month.
A month. Okay. Yeah. Thank you, sir.
Thank you. Next question is from the line of Soumya V from Avendus Spark. Please go ahead.
Yeah, thanks for the opportunity, sir. First question is on the Nagapattinam refinery. The revised cost, what would be? What would be our share of equity? What would be the debt for the project? And what is the level of equity that we have spent and what we need to spend in the next couple of years?
Yeah. So the revised project cost is 36,354 crore. CPCL share is 25%. Debt is 1:2. So, total equity will be 12,000. 25% of that is 3,000 crore. That is CPCL's contribution. As I said little bit ago, that the land is 100% received. All EPCM awarded. All other projects are kept ready for award. And as soon as we receive CCA approval, we should be in a position to award. And the commissioning, mechanical completion is 36 months from CCA approval, and commissioning is 39 months.
So, of this 3,000 crores of our equity contribution, how much have we spent so far, and what is the expectation?
1,000 crore has been spent so far.
Okay. And in this current year, CapEx of 650 crores, what would be the equity contribution? Is this included in the 650 or it's outside?
Not very significant because CPCL is upfront that equity of 1,000 crore. So not significant equity will flow in the current year, but yes, subsequent year or later part of this year and subsequent year, the balance money will go.
Understood, sir. And also any kind of government benefits that is expected for this refinery, either in forms of tax breaks or anything that is expected?
Yes. So last time state government had given a package, incentive package, that is the stranded taxes and the GST portion for the petrochemical. Those things will continue. We have signed a non-binding MOU in the last GIM, Global Investor Meet, and we are processing the administrative process and hope that notification will come soon.
Okay, got it, sir. So now also the 650 crores of capex that we have planned for this year, how much would be maintenance and how much would be for new projects, and what it would be?
Not significant part will be for CVRTL. So maybe around 200-300 crores will be maintenance capex, and some we have kept provision for profitability projects as well.
Got it, sir. And also on the crude sourcing mix, can you just help us out broadly, the regions of crude sourcing and also how the premiums and discounts from these places have been for us, how things are currently versus, say, last quarter?
So broadly, the crude basket, Middle East is around 47%, indigenous 13%, African, West African 9 to 10%, and balance 30-odd%, is, we look at spot, including Russian opportunity crude. So that is it. And if you say in a different perspective, long term would be around 50%. So long term minus, long term plus the domestic crude. The balance is available for spot, depending on economics and depending on opportunity available in the market.
Got it, sir. And anything on the premiums or discounts for these crudes, how you have seen things moving vis-a-vis last quarter?
Yes, I can tell you the premium and discount. The Arab mix, last quarter, Q4 23-24, the premium was 1.81 as compared to 1.53 of the corresponding quarter of previous year. But if you compare with Q3, it has come down. Q3 Arab mix premium was 3.5. Q4 was 1.81. If I compare year versus year, full year 22-23 Arab mix premium was 5.1 and 23-24 Arab mix premium reduced to 2.5. Same is the case for Basra medium. On a full year basis, Basra medium 22-23 was 2.8 and 23-24 full year was 0.5.
Got it, sir. And currently, these numbers, how are they trending?
Currently, See, from March to April, we have not seen a significant change, but it's still too early when we look at the full year.
Understood. Sir, and also on the product slate, you did give the distillate 76%, but possible to share at a individual product level, what would be the product slate, say, for FY24, and any meaningful change that you expect after this smaller project that you're referring to, in terms of product slate change?
If you are looking at 24-25, we are not expecting a significant change in product slate, because as you know, this depends on design, and smaller value-added products will not change the overall product portfolio significantly. But yes, once we do implement a project like LOBS, which will take 2-3 years, then maybe 2-3% change we can expect in some of the products.
So possible to share in FY24 what would have been our, individual product level, like petrol, diesel, jet fuel?
25 is the product slate is not likely to be very different than the present year, that is 23-24, except for impact of any M&I setup.
Got it, sir. This is helpful. Thank you.
Thank you. Next question is from the line of Mayank Maheshwari from Morgan Stanley. Please go ahead.
Hi, sir. Just wanted to talk about a bit on the capital allocation and the debt side. You have seen obviously a big reduction in your net debt over the last few years. How are you seeing that kind of play out now into fiscal 25, and what are the kind of dividend payouts that you're thinking about in the light of the capex you're doing on the new refinery?
On the debt side, if you see 2-3 years back, the debt equity was as high as 7, or rather it crossed 7. Now consistently for the last 2 years, it is managed well within 0.5. So, and we have profitable projects, so that gives us some cushion, to take advantage of the profitable opportunity, margin enhancement opportunity. So in this light, we see there is no trade-off at this point of time between dividend and projects or debt levels, because debt levels are already within manageable limits, or rather benign. It's hardly 2,700 crore at this point of time.
So in light of this new capex that you are doing, you think this number kind of peaks out at a certain level after which you would be getting a bit worried around the debt levels, or you think it's very much manageable despite that?
One of the we talked about is investment in CBRPL project, which is 3,000 crore. Out of that, 1,000 crore is already spent, and that is part of the present balances. Immediately in this year, allocation will not happen there, and the whole 2,000 crore will spread over 2 to 3 years. And they'll be earning, there'll be increment in net worth, debt levels are already down, so we don't see any reason at this point of time, and we feel it's balanced. It is balanced, and it remains balanced at that level.
Got it. And so the last question, just on dividends, considering I think you have paid a healthy dividend in fiscal 24, you think that's going to be now sustainable going forward?
It is on dividend. We said we are a government company. DP guidelines, DPAM guidelines are applicable to us. So we, it's a stated policy. We have put that policy in our website. And the only other consideration we see is financial stability and future growth and future profitability. And we need to balance both of these. And we have been balancing. If you see last year, we had robust profit, but we felt some profit needs to be harnessed at that point of time. We harnessed it. This year, back to back, there was excellent results, good physical and financial performance. And accordingly, we acted and we distributed. I feel keeping into the future profitability, future growth capex availability requirement, we'll again do a balance between retention and distribution, keeping the overall interest of the shareholders and stakeholders.
Okay. Thank you, sir.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Gagan Dixit from Elara Securities. Over to you, sir.
Yeah, thanks for all the participants, and special thanks to Shri Rohit Kumar Agarwalji and his team for their views on the company's fourth quarter performance. And again, congratulate them for the excellent set of numbers. Any closing comments, sir, and then you can conclude.
Thank you, Gagan. I think I would like to end with only one statement that CPCL is very focused and very committed to operational performance. We'll continue to do this so that whenever the market gives that opportunity, the opportunity will be harnessed for the benefit of shareholders.
Thank you.
Thank you.
On behalf of Elara Securities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Yeah, thank you.